What's going on, everyone? Welcome to the Geeky Investor, where stocks talk and we translate. Today, we're going to talk about why the stock market is crashing and what you should do right now. So, before we begin, I'd like to show you a couple of examples of stocks that are really crashing. And actually, it's not just stocks. If you see here, Bitcoin over the last month, it has decreased by around 20%, which is a significant decrease here in just 1 month. We can also see the same thing happening in Nasdaq. So we see that it's been down around 4 to 5% since its peaks within the past month. The same goes for different stocks. So for example, Palantir here, we see that it's down 16%. Tesla, the same goes for Tesla. It's been down around 3 to 4, or even actually around 10% for Tesla. The same goes for Nvidia, but maybe reaching 12%. Now, on the other side, we can see that all of these stocks are crashing. All these stocks, if you see Bitcoin, I know it's not a stock, but Bitcoin, the Nasdaq, Palantir, Tesla, Nvidia, they're all kind of related in one way or the other to AI. So one might think, well, if all of these stocks are crashing, these stocks specifically, then are we expected to be in an AI crash? But what I can show you here is that the opposite is happening to some stocks. So for example, if you look at Apple, we see that the stock has been up 5% in the same period that these other stocks have been down, which is interesting to know. Although Apple is relatively more invested in AI as compared to some other companies, but compared to the prior ones, maybe not as much. So we see here with Dow Jones, it's down less significantly as compared to the Nasdaq. So we remember that the Nasdaq here, it was down by around 4 to 5%, but here Dow Jones is just down 2%, and we all know that Dow Jones is less tech heavy and less AI related. So what I want to discuss here today is, are we actually in an AI bubble, or what's happening? So this downturn appears to be concentrated in AI-related and tech-focused stocks, while more traditional sectors remain relatively stable. So the Dow Jones is an example. Now, what I want to show you here is, if you look at the Fear and Greed Index, which is a very well-known index that shows the appetite and what the investors like you and I and those others are thinking about the stock market right now. And as we can see here, they are actually on the left side of the graph here, so on the extreme fear as compared to the extreme greed on the right side. Okay, so what does that mean? It's just 14%. So it's a scale from 0 to 100. If you're more towards the 100, so you're in the extreme greed. That's, for example, in the 1999 and 2000 before the dot-com bubble. Now, what we're experiencing in the stock market right now is an extreme fear, which is sometimes seen before or during market corrections, or sometimes market crashes, and then that tends to change over time after the market digests this crash or this correction, and then moves on forward. Because as we all know, the stock market has been going up actually without almost forever. It's been down from time to time, but as you can see here, from 1985 all the way into 2025, we see that after every crash, the stock market just recorrects and goes up back again. Now, we can see that the Fear and Greed Index in other things. So this is for the stock market. We can see that the stock market is in extreme fear, which means, that investors are actually here over the left side. If you're seeing extreme fear, 13%. So, sorry for that. So the investors are extremely fearful of the current stock market, and they are selling stocks more than they are buying because they are really fearful. That's one way to interpret it. Another way is people or investors are less buying stocks, or especially speculative stocks, or those without actual proven profits, because they are afraid that the stock market currently is not in a reliable situation. We can see the same is happening for crypto, but it's slightly less fear as compared to the stock market, but we can see that it's in the extreme fear territory. So what we want to talk about here is investors are showing extreme fear according to this index. However, unlike market tops where the index is usually in extreme greed, I'll just show you the highlighter here so that it's more clear. This indicates that investors are either being cautious and disciplined, or that they are currently in a market correction that could go broader or could deepen, become even worse, or maybe from here it could rebound and go back up. So by definition, we are already in a correction. So if you just focus on this chart right here, so 10%, 15 or 20%, and the average frequency of each of that and the duration. So what we can see here is a decline of 5% happens almost 3 times a year and lasts for between a month and 2, while a decline of 10 to 15%, which what we're experiencing right now, if you see the Nasdaq, it's down around 10%. So this correction happens almost once every year. So that's really expected, guys. And this occurs over 3 to 4 months. So we've seen that happening over the past month. Maybe things are changing. As we know, usually stock market, when it crashes at 20% or more, it stays for almost a year. However, we saw in the coronavirus crash, which we've all experienced, the stock market crashed for just like a month, 21 days, if I recall correctly. So, maybe things are just happening more faster. The pace is just significantly less prolonged as compared to before. So maybe this 10% correction, it usually happened over 3 to 4 months. Now it's happening over just 1 month. So maybe, who knows, maybe we would go into this 15 or 20%. But what I would have to tell you is that this is just happening regardless of what investors think, regardless of what the analysts are saying. So what you have to do is you have to just stay rational. What you have to do is you have to do dollar cost averaging. And what I mean by dollar cost averaging is this. So we can see that the timeline here on the x-axis, so over time, you're getting more shares of this stock. So this green area shade over here. So you're gaining more stocks over time by just buying stocks at different prices without actually looking at what analysts and the stock market and people are saying. So you're just being kind of like a passive investor. You're buying and averaging over time. So this is the best strategy for most people who don't know how to pick stocks. But what we do here in this channel is we're talking about the stocks. We're trying to educate ourselves. So what we're trying to do is build wealth over time better than just dollar cost averaging. Although on the long term, this method is actually good. Now, the second important thing that you have to do is you have to buy companies with good and solid balance sheets. So here we see on stock analysis website for Nvidia Corporation, I'll just zoom in a bit. We can see here that we're looking at the balance sheet. So if we go, we see here on the x-axis, it's the years 2021 all the way into 2025 on the left side. And we can see that the cash over here has been significantly increasing over the past 5 years. And then when we compare that, so Nvidia has a cash of currently as of $11 billion. But if we look at the debt that the company has, its long-term debt is $7.4 billion. And we know long-term debt means it has to be paid after at least 12 months. And for the short-term debt, it's actually not mentioned here, showing that it's actually not there. So we can see the current portion of the long-term debt. So we have almost just $1 billion. So they have to pay, or Nvidia has to pay just $1 billion within the coming 12 months. But they actually have around 11 billion. So they're just paying 1 out of 11, which is, I don't know, like 8% or something. So this means that this company has enough cash to fuel its growth, to pay for its debt, and to pay its employees, and to grow even larger. So this is one of the criteria that we have to look into when we're actually investing and actively investing in stocks. And that's what we're trying to do here. But of course, I'm not just telling you that you have to buy Nvidia right now, because it also depends on the price. But what I'm saying here is that the the balance sheet and the cash to debt ratio is really important, and this is called the current ratio. So if we go to the ratios tab here, we can see something called current ratio. So if we hover over here, if you hover over current ratio, here it says that it is the current assets over current liabilities, and we know that the major current asset is the current cash, and the major current liabilities is the current debt. So if the ratio is high, this means your cash is high and your debt is low, making the ratio high. So we can see that Nvidia's current ratio 4.4 is really strong, and any current ratio above 2 would show that the company is really strong from a balance sheet perspective in one of the most important aspects that we can see. And with that, I would like to tell you here that the best strategy for individual investors is dollar cost averaging. Focus on companies with strong fundamentals, positive cash flow, and solid balance sheets with low debt levels. And as we just saw with the current ratio, avoid speculative trading behavior, so don't try to time the market. And as short-term movements are often irrational, even companies, for example, Nvidia. You guys remember in Nvidia, it had a very good quarter, just a quarter earnings a few days ago. But unfortunately, what happened is that the stock market, or actually the Nvidia stock, it went down. Although the results were really good, but it went down. So you don't have to be speculative and just, I'll just buy one day prior to the earnings and sell the day after. You're gonna lose money doing that. Maybe one time you would make it, but on the long term, on the long horizon, you would just lose money. So please avoid these speculative movements, and I'll see you in our next video. Take care. Bye bye.